Hey guys, Chad Trades here. So in this video, I want to show you a day trading strategy from 1986 that I wish I knew as a beginner. Now, not only has this strategy been proven to work for decades now, but I've actually been trying this strategy the entire month of May, and this has been one of my best trading months I've ever had. I'm up over $20,000 in profit. Like I said, following this exact strategy that was created way back in 1986, and it still works very good to this day. So that being said, super excited to show you guys what this strategy is and how it can help you inside of your trading. Let's go and dive straight into it. All right, so if you don't know, this strategy is created by Richard Dennis. It's called the Turtle Trading Strategy, and it got invented in the 1980s. And this guy, Richard Dennis, he started with $5,000 and turned it into over 100 million back in the 1980s. Now, a lot of people, especially in the trading space, they like to see the new strategy, the new confirmations, the new indicators, right? But in my opinion, I think it's better to follow a strategy that's been proven to work for decades, right? Versus something that's new, has a lot of hype around it, but doesn't have a lot of proven results, right? It doesn't have a big track record. This is why I want to bring this video to your guys' attention to go over a strategy that I've been following that's been working for decades and decades and decades. Now, the first principle for this strategy is going to be following the trend, right? Basically saying, hey, listen, you should only trade with the trend. Now, this is one of the things I started doing this month. And like I said, I've had one of my best months ever as a trader, only following the trend. And the way I think of it is you want to compare it to surfing, for example, right? As a surfer, you're not going to surf against the wave. You're going to surf on the wave. You're going to surf with the wave. The trend is the wave in the market. You want to trade with the wave, with the trend. Now, you might be wondering, well, Chad, how do you actually determine what the trend is? Okay, so an easy way that I like to determine what the trend is I'm on a 5-minute time frame, and I like to look at the 5-minute 45 length EMA line, which is this blue line right here, and the VWAP. So basically, if we're trading below these two lines, that tells me the trend is down, and I only want to look for short setups. If we're trading above this EMA, above this VWAP, that tells me the trend is up, and I only want to look for long setups. Now, the next principle that this strategy talks about is simply just position sizing. A lot of you guys should know this already. Basically, it just tells you don't risk more than 1% of your portfolio. This can be a little bit different for everyone depending on your account size. So like me personally, I trade with prop firms. So my position sizing rule, basically, if I lose 10 trades in a row, I'm going to blow my account, right, on my prop firm accounts that I trade with. And following my system, I should never have a scenario where I lose 10 trades in a row, right? That means something's broken. I deserve to blow my account. I probably went in tilt mode. So that's kind of my rule of thumb is I'm allowed to lose 10 trades in a row before I blow my entire account. That's kind of how I manage it. Obviously, if you have $1,000, right, you're not going to be able to risk only 1% of your portfolio. So just trade with the smallest size you can. If you're trading options, trade with one contract. If you're trading futures, trade with one micro contract, right? You kind of get the point. You guys should all know this principle. Now, the third principle that this trading strategy follows from the 1980s is having specific entry and exit rules. So I put my own spin on this a little bit. Again, I don't think the most important thing is to follow exactly what he's doing, exact moving average he's using, right? The most important thing is to follow the principles. Following the principle of only trading with the trend. If you just do that, that will immensely help you. I can almost guarantee you that. Okay, principle number 3, have rules for your entry and exit rules. You don't have to follow my exact rules. You don't have to follow his exact rules, but have some rules, right? So for me personally, my rules, if you guys are wondering, and again, kind of going back to the surfer analogy, right? Just because we see a wave coming, we want to make sure it's a good wave, right? We want to make sure the wave's not going to be too choppy. We want to make sure the wave's not going to all crash at once, right? So we want to determine whether the wave is actually going to be worth taking, whether the trade is actually going to be worth taking. So me personally, what I follow is on the left side, I have a 5-minute time frame. This tells me what the trend is. So we can see during this time, let's say you came to your computer at 11 a.m. my time on this candle, we can see the trend is up because we're holding this EMA line. So that tells me I want to look for long setups. So what I can do is I can go on the 2-minute time frame. This is my specific rules that I follow, right? You don't have to follow these. You can do your own rules, but this is what works best for me. These are my confirmations, right? Basically what I'm looking for is I'm using a 2-minute MACD. I want to see the 2-minute MACD cross, and I want to see a 2-minute Heikin-Ashi candle. So as you can see, we got that right here. We got our first green 2-minute Heikin-Ashi candle no wick at the bottom, and our MACD already crossed. So in this scenario, I'd enter the trade right here. As you can see, this trade pretty much had no drawdown and it ripped up nearly 25 points from where I would have entered. Or we can go to another example. This is on the S&P 500. We can see that, basically when we got this big selling, the trend was down. We're below our EMA, we're below our VWAP. So this tells me I only want to focus on short setups, right? So I would look for the same thing, right? I would go into the 2-minute time frame, and this time we got to pop up. And basically the MACD got pretty close to crossing and then recrossing. It didn't exactly cross, but we can see the histogram kind of shows it better. It basically went flat and then it started gaining momentum again. So this is where I'd basically look for a red Heikin-Ashi candle. Since we're going short in this case scenario, I could enter the trade right here where this candle closed, get in, I could put my stop right above this candle, and I could ride the wave back down. Again, we only knew to go short here because of that first principle of what is the trend. We can obviously see the trend is down because we're below this EMA, we're below the VWAP, so we have a higher probability of making money if we go short. Now, the last principle that this strategy talks about is basically just risk management, and this is essentially just having a stop loss. So this is something every trader should be following, obviously, right? And the way I think of it, again, going back to the surfer analogy, I think it's just a good analogy, is think of this as managing the trade. If you're on a wave, you're in a trade, you want to get off the wave before this thing comes crashing down, you give away all your profits. Or in this surfer's case scenario, if this wave crashes on him, he's going to be held down for minutes and minutes, and it's going to be super painful for him. So as a trader, we have to manage our risks, right? We have to know when to get out of the trade. We have to know when the wave is going bad, when it's going to crash. There's a few things you can do for this. So me personally, going back to this NASDAQ example, when we start getting above this EMA, we got this entry confirmations, we got the MACD to cross, we got this 2-minute Heikin-Ashi candle. Basically what I want to do is I want to either have a target, and I also want to trail my stop. So when I originally entered the trade, I'm always going to put my stop loss below the candle I entered on. Okay, so now I can see I have a very limited risk. I would be risking around 6 points on this trade. Now I can have a target based on my risk reward. So if I'm risking 6 points, maybe my target will be 12 points. I can do it that way. As you can see, that would have hit. We went up 12 points. It would have been right here. Or we can base our target off our last resistance. We can see we definitely had some resistance in this 20 area. So we could have had a limit order to sell our trade here and, get off the wave before it comes crashing down like it's doing now. Or another option you can use is you can trail your stop, right? So after each green candle, I can put my stop below the lows. So once this candle closes, I can move my stop to 697. Once this candle closes, I can move my stop to 701. Once this candle closes, I can move my stop to 706. Once this candle closes, I can move my stop to 712, right? You kind of get the point. Now, again, the way you're managing your risk, whether you're going to do a target based on your risk reward, or you're going to do a target based on the last resistance, or you're just going to trail your stop until you get stopped out, right? Again, the tactics don't matter, right? Just like the entry confirmations, the exact tactics don't matter. What I really want you guys to take away from this video and be able to apply to your own trading is following these principles, the principles of risk management. This is obvious. The principle of having specific entry and exit rules. For me, this is a 2-minute MACD cross and a 2-minute Heikin-Ashi candle with supporting volume. The principle of position sizing. Don't let one bad trade blow your account. Give yourself some chances to lose, okay? It's okay to lose in trading. You're going to lose once in a while. Then obviously this last principle, which I think is the most important, is following the trade, trading with the trend. So again, I kind of break it down into 3 steps, right? Step 1, establish a trend, see what the wave is, only trade with the wave. Step 2, entry confirmations, see if it's a good wave or not, right? Make sure it's not going to be too choppy. Make sure the waves, you're actually going to be able to ride the wave so you can make some money. And then once you're on the wave, once you're in the trade, is managing it, right? Knowing when to get out of the trade, being able to manage your risk, and making sure it doesn't come crashing down on you. So anyways, guys, real quick before you go, I want to invite you to join our free Discord community. Inside of here, I show my exact levels every single day on the S&P 500 and the NASDAQ market. We also have all kinds of resources in here, including all kinds of other traders that you can actually chat and network with. So anyways, if you guys would like to join this community, we'd love to have you inside. All you have to do is go to the first link in the description below, or just head over to this link right here. With that being said, guys, as always, I hope you enjoyed this video. Go apply some of these principles, some of the stuff I shared in here to your own strategy. And I guarantee you, you're going to get better results over the next few weeks. That being said, if you have any questions, let me know in the comments. And as always, I hope you have a great rest of your day, and I will see you in my next video with another day trading lesson.